Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. Today we're diving into First Northern Community Bancorp's quarterly report, and let's just say their numbers are interesting, to say the least. Get ready for some insights that might just surprise you, and hey, if you are one of those people who loves digging into the real financial stories behind companies, make sure you hit that subscribe button and join our Discord community, linked below for even more insider info. So what are we looking at here? This is a quarterly report specifically for the period ending the 30th of September 2025. Think of it as a financial snapshot of the company 3 months into the fall. They are a community bank operating mainly in Northern California, focusing on what banks do best, taking deposits and making loans. Now, let's see how they're doing financially. First up, the balance sheet. This is where we see what the company owns and what it owes. At the end of September 2025, First Northern had total assets of about $1.9 billion. That is a pretty solid number. Their loans, which are a big part of their assets, were just over $1 billion. That is pretty much in line with where they were at the end of 24. What's interesting is their cash and cash equivalents jumped up by about 25% since the end of last year, reaching nearly $150 million. That's a significant increase in readily available cash. On the flip side, they saw a decrease in their investment securities. Let's break that down. Their total assets are $1,908,208 or $1.9 billion. That is a slight increase from the end of 2024. Now, let's look at the other side of the balance sheet: liabilities and stockholders' equity. Total deposits, which are essentially what people have put into the bank, were just under $1.7 billion. That is actually down slightly from the end of 2024. This slight decrease in deposits, coupled with that big jump in cash, might suggest they are being a bit cautious, perhaps anticipating higher demand for loans or just holding on to more cash for stability. Moving on to the income statement, where the real story of profitability unfolds. For the 3 months ending the 30th of September 2025, their net income was $6.0 million. That is a nice increase compared to the same period last year, up about 9.6%. For the 9 months of the year, their net income was even better at $15.2 million, an increase of almost 7% from the previous year. This shows steady growth in their bottom line. And what does that mean for shareholders? Diluted earnings per S-share for that third quarter of 2025 was $0.38. That is up from $0.34 last year. For the year so far, it is $0.96 per S-share, also an improvement. This is the kind of growth investors like to see. Now, a key metric for banks is net interest income. This is the difference between what they earn from loans and investments and what they pay out on deposits. For the third quarter, they brought in $16.8 million in net interest income, a small increase from the previous year. Year to date, it is $49.7 million, up about 4% their net interest margin, which shows how efficiently they are making money from their interest, bearing assets and liabilities is looking pretty healthy and actually improved slightly compared to last year. This is a positive sign for their core banking operations. Here is something that really catches the eye. For the 3 months ending the 30th of September 2025, their provision for credit losses was $0. That means they did not anticipate needing to set aside any extra money for potential loan defaults in that quarter. Even for the 9 months of the year, the provision was $0.9 million, significantly lower than the $0.2 million last year. However, comparing to the same period in 2024, there was a reversal of provision, meaning they took money back from their credit loss reserves. This current trend of low or no provision for credit losses is generally a good sign, suggesting they view their loan portfolio as pretty healthy right now. Beyond just interest, banks earn money from fees for services. Their total non-interest income for the third quarter was $1.7 million, up from $1.5 million last year. This is mostly from things like service charges on deposit accounts and debit card fees. Year to date, it's $4.6 million, also a slight increase. This revenue stream is stable and contributes positively to their overall income. Now, let's talk about what they spend. Non-interest expenses, which cover things like salaries, rent, and technology, were $11.9 million for the quarter, up from $10.9 million last year. For the 9 months, it's $34.4 million, an increase from $32.5 million. This rise is mainly due to more staff, higher occupancy costs, and increased data processing expenses. It's not unusual for expenses to go up, especially if the company is growing or investing in its operations, but it's something to keep an eye on to make sure it doesn't eat into those profits too much. Looking back at the balance sheet, their assets are just over $1.9 billion. This has grown slightly since the end of last year, showing some expansion. Their total net loans, which are the money they've lent out, are just shy of $1.1 billion. This has also seen a small increase, which is generally what you want to see as a bank, as it means they are actively lending. And their deposits, their main source of funding, are just under $1.7 billion. As we saw earlier, these have slightly decreased. This makes their loan to deposit ratio, which is now 62.6%, a bit higher. While still healthy, a higher ratio means they are relying more on their loans relative to their deposits. Let's dig a bit deeper into their investments. Their taxable investment securities averaged $545 million for the quarter, yielding about 2.96%. Their non-taxable securities averaged $52 million, yielding around 3.19%. These are important for managing interest rate risk and providing liquidity. Interesting to note, the yields on these have increased slightly from the previous year. When we look at their equity relative to their assets, it is about 10.43%. This is a good indicator of their financial stability. They are not overly leveraged, meaning they are not borrowing excessively compared to their own funds. Now, let's talk about risks. Anytime you are dealing with a bank, understanding the risks is crucial. They mention a big one here, changes in US and foreign government policies, specifically tariffs. This is particularly concerning for their agricultural customers. If trade wars escalate or tariffs increase, it could hurt their customers' businesses. And that directly impacts the bank's loan portfolio. Given the dynamic nature of trade agreements and potential retaliatory tariffs, this is a significant area of uncertainty. They also highlight the ongoing risks in the banking industry following the failures of some banks in 2023. This could mean more regulations, higher capital requirements, or even increased deposit insurance costs. The report points out that customers might move their money to larger banks or seek higher yields elsewhere, which could affect their liquidity and funding costs. While they say they have diversified funding sources, a sudden liquidity crisis is always a possibility. And then there is interest rate risk. This is a classic for banks. Their income is heavily tied to the difference between what they earn on loans and what they pay on deposits. If interest rates fluctuate wildly, it can squeeze their profits. They mention the Federal Reserve's actions to combat inflation, including rate hikes and more recent cuts, which have made the yield curve behave in interesting ways. This can affect loan demand, the value of their investments, and their own borrowing costs. Inflation is another big concern. A prolonged period of high inflation could lead to tighter financing conditions, higher borrowing costs for some customers, and potentially more loan defaults. This is a complex economic environment they are navigating. Looking at their stock buyback program, they repurchased about 97,000 shares in the third quarter of 2025. This is a way for the company to return value to shareholders by reducing the number of outstanding shares. And finally, the certifications. The CEO and CFO have signed off confirming that their disclosure controls and procedures are effective. This is standard stuff, but it shows they are attesting to the accuracy of their reported information. So, what is the story here? First Northern Community Bancorp seems to be navigating a challenging economic landscape with steady, if not spectacular, results. Their net income is growing, their loan portfolio looks stable, and they're not seeing significant problems with credit losses right now. The zero provision for credit losses in the latest quarter is a particularly strong indicator of current asset quality. However, they are exposed to significant risks from trade policy changes, the broader banking industry's stability, interest rate fluctuations, and ongoing inflation. These external factors could challenge their growth and profitability going forward. They are holding a good amount of cash, which might be a sign of prudence or perhaps anticipation of future economic shifts. Overall, First Northern appears to be a stable community bank, but the broader economic and geopolitical risks they've highlighted are definitely worth watching. Their strategy seems to be focused on steady lending and deposit gathering with a solid capital base. Alright, that is our decode of First Northern Community Bancorp's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their cautious approach with cash is smart or a sign of underlying concern? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into corporate finance. Don't forget to check out our Discord in the description for more discussions and exclusive content. Thanks for watching. See you next time.